In this video, we will explore about the kinds of transactions and dematerialization and rematerialization of securities. When we look at the financial markets, not all trades happen in the same way or at the same time. We can categorize transactions based on two main things. First is the settlement time, which asks whether the deal is finished immediately or if it is settled in the distant future. The second is the location, asking if the trade happens on a formal exchange or outside of it, which we call over the counter or OTC trades. Let us break down these different types of trades to understand how they work. Moving on to the timeline of settlements, we have three distinct categories known as cash, term, and spot trades. First, look at the left side of the screen at cash trades. Here, the settlement, meaning the payment and delivery, happens on the same trading day. We call this T+0. While this is rare in complex financial markets, it is actually how we live our daily lives. When you buy groceries or vegetables, you pay cash and get the item immediately. That is a cash trade. Next, we have term trades, which is short for tomorrow. In this case, the settlement happens on the day next to the trading day, known as T+1. This is very common in foreign exchange markets. Finally, there are spot trades. This settles on the spot date, which is normally 2 business days after the trade, or T+2. In India, the equity markets typically follow this standard spot settlement cycle. Now, let us shift our focus to deals that are settled in the future, starting with forward transactions. A forward contract is a customized agreement between two parties to buy or sell an asset at a future date, but the price is decided today. Because these are negotiated privately between two people, they are OTC contracts. Both parties have an obligation to honor the deal, regardless of what the market price is later. However, because this relies on mutual trust, there is a risk that one person might default, which is called counterparty risk. For example, imagine a farmer agrees to sell his wheat crop to a miller 6 months from now. They agree on the price, quantity, and quality today. Whether the price of wheat goes up or down in 6 months, they must stick to the agreement they made today. To solve the risk associated with private forward contracts, we have futures. Futures are essentially forward contracts that are traded on an exchange. The big difference here is that they are standardized. This means the exchange decides the quantity, the quality, and the delivery terms. So you don't have to negotiate them yourself. Also, there is no counterparty risk because the clearing corporation guarantees the trade, though they will ask for margins to ensure safety. For instance, look at the example of wheat futures traded on the MCX. The exchange specifies that the trading unit is 10 metric tons, the minimum order size is 500 metric tons, and the quality must meet the standard mill quality. Even the delivery dates are fixed, such as the 20th of the month. Next, we enter the world of options. An option is a very interesting contract because it gives you the right to buy or sell something, but not the obligation to do so. You pay a price called a premium to buy this right. There are two main types. A call option gives you the right to buy an asset at a specific price. A put option gives you the right to sell an asset at a specific price. In this relationship, the person who buys the option is the holder who pays the premium. The person selling the option is the writer, and they receive the premium but must take on the obligation to fulfill the contract if the buyer wants to proceed. Let us make this clear with a practical story involving two people, Arvind and Salim. In this scenario, Arvind acts as the buyer and Salim is the seller. They enter a contract based on the Nifty 50 index. The terms are simple. The strike price or the price at which they agree to trade later is 11,000. The timeline is 3 months. To get this right, Arvind pays Salim a premium of 100 rupees today. Now, the rule is that Arvind can choose whether or not to exercise this option. However, if Arvind decides to buy, Salim must sell the index to him at 11,000 no matter what the current market price is. Let us see what happens 3 months later on the settlement date. We have two possible outcomes. In the first scenario, imagine the Nifty goes up to 11,200. This is good for Arvind. He can exercise his option to buy at 11,000 even though the market price is higher. His gross gain is 11,200 minus 11,000, which equals 200. Since he paid a premium of 100 rupees, his net gain is profit of 100. Salim unfortunately makes a net loss of 100. In the second scenario, imagine the Nifty drops to 10,800. It makes no sense for Arvind to buy at 11,000 when the market is cheaper, so he lets the option expire. Arvind's loss is limited to the premium he paid, which is loss of 100. Salim keeps the premium, making a profit of 100. Another important derivative instrument is the swap. As the name suggests, a swap is a contract where two parties agree to exchange cash flows in the future based on a pre-arranged formula. This is often used to manage risks related to interest rates or currencies. In the example on your screen, we have a borrower and a swap dealer. The borrower wants certainty, so he agrees to pay a fixed rate of interest to the dealer. In return, the dealer pays him a floating rate, which might be linked to the treasury bill rate plus a spread. By doing this, the floating rates cancel out and the borrower effectively converts a risky floating liability into a stable fixed rate obligation. Now that we understand the instruments, let us distinguish between trading and speculating. People often mix these up, but they are different. Trading is usually short term, lasting hours, days, or weeks. Traders rely on technical analysis and look for historical patterns in prices. Speculating, on the other hand, can be for any period but is often risky. Speculators rely on rumors, insider information, or their own gut feeling about fundamental changes. The key difference is probability. Traders usually have a higher probability of gains compared to speculators. However, both of them use leverage, meaning they borrow funds to increase the size of their bets, which magnifies both their gains and their losses. Next, we have hedging. Unlike trading or speculating, the goal of hedging is not primarily to make a profit. The motivation here is to avoid losses. Think of it as an insurance policy for your investments. Hedging involves buying a contract to offset potential losses in an existing investment. For example, if you own a stock and are worried the price will fall, you might buy a derivative that gains value if the price falls. The ideal result of a perfect hedge is a squared off position, meaning no gain and no loss. The loss in your asset is balanced by the gain in your hedge contract. Then there is arbitrage. Arbitrage is the act of simultaneously buying and selling an asset to profit from a price difference in two different markets. Look at the diagram. An arbitrager sees that an asset is priced low in market A and high in market B. They buy in market A and instantly sell in market B to make a risk-free profit. This is very important for market efficiency. Because they are buying in the lower priced market, the price there goes up. Because they are selling in the higher priced market, the price there comes down. Eventually, this closes the gap and eliminates the opportunity. We also need to understand the concept of pledging of shares. This is when an investor takes a loan against the securities they hold in their demat account. The investor is called the pledgor and the lender is the pledgee. When you pledge shares, they remain in your account, but they are blocked, meaning you cannot sell them or use them for other trades. If you repay the loan, the shares are unpledged and released. However, if you default and cannot pay, the lender can invoke the pledge. This means the lender takes control of your shares and sells them to recover the money they lent you. Finally, let us discuss the concepts of dematerialization and rematerialization. Dematerialization or demat is the process of converting physical paper share certificates into electronic book entry form. In this form, shares do not have distinctive numbers, they are just digital entries. SEBI mandates that new public issues must be in demat form. On the other side of the cycle, we have rematerialization. This is the reverse process, where electronic holdings are converted back into physical certificates. If an investor requests this, the electronic shares are removed and physical certificates with distinctive numbers are printed and given to them. This completes the cycle of securities handling in the modern market.